All right, this is a totally different topic, but I would like you to know a little bit about it. It's the issue of who is required to file a tax return. Well, you're only required to file a tax return if you have taxable income. And you're only going to have taxable income if you're above the standard deduction. You remember again the standard deduction? For again, a single person, the standard deduction was $12,200. If you have more money than that, you owe taxes. If you're married filing joint, it's $24,200. Whoops, that's $24,400. Double that. If you're married filing single, it's back to $12,200. And if you're head of household, what did we say that was? $18,350? I must have troubles with that one. So my point is, the law says if you make more than this, you're going to have to pay tax. If you make $12,001, $12,201, you're going to have to file a tax return because you're going to have taxes. Now, if you make less than this, you don't owe any taxes, so you don't have to file. But here's a super big tip. Almost all of you college students probably make less. Many of you probably don't make $12,200. Why, then, would you be foolish enough to fill out a tax return to get your withholding back? Almost all of these, we're going to look at them and say, well, these people don't have to file a tax return, but they should, because they'll get their withholding back. In other words, the government owes you the money back. If you don't file that tax return, you won't get your money back, your withholding. Many of you don't pay federal taxes. Again, if you're under that now, you won't have to pay federal income taxes. Patricia, age 19, is self-employed, single individual. Oh, by the way, there is one more rule. If you do have your own business, if you're self-employed, if you make greater than $400 of income, you have to file a tax return. Now, why is this number so low and these are so big? If you're self-employed, Congress is very suspicious of people who are self-employed. That's where a great deal of tax fraud goes on. If you took more tax accounting, I could explain it to you, but again, small business men and women, there's probably other reasons for that, but small business men and women, usually that is a great and very vulnerable area in the tax code. They can hide their income very creatively. So Congress wants to see their tax return to see if it's valid. Anyway, Patricia, age 19, is a self-employed single individual with gross income of $52,000 from a business. Business expenses amounted to $49,000. If you take $5,200, there's her income, minus $4,900 are her expenses. That's $300. Boy, does she get lucky. She does not have to file. So that's what they ask, isn't it? Oh, that's fight. She does not have to file. Individuals which are, oh yeah, she does not. She only makes $300, that's less than $400. Mike is single, 67 years old. His gross income from wages was $10,800. Well, a 67-year-old man is going to get a standard deduction of $12,200, plus he's going to get $1,650 additional standard deduction. So that's going to be $13,850, is that right? 2 and 6, yeah. So this guy, no, he doesn't have to file. So no, and the answer is no. Mike, this is no. No, he doesn't have to file. And no, Patricia doesn't have to file. You see, again, that's because his gross income was $10,800. That's less than $13,850, this standard deduction. He should file, though. He'll get a refund. He'll get his taxes back. Ronald is a dependent child under the age of 19 who received $6,800 in wages from a part-time job. Do you remember this one? A dependent child gets what? Their earned income, $6,800 plus $350, or $1,100. This is going to be $7,150 versus $1,100. Do you remember that? We did that earlier. They get the greater of the earned income plus $350, or they get $1,100. So he's got $750. He received $6,800 in wages from a part-time job. Well, no, he doesn't have to file. No, he doesn't have to file, but he should. No, he doesn't have to file. Again, you see his income is less than his standard deduction. And again, you wouldn't take that 11. But he should to get a refund. Sam is married and files a joint return with his spouse, Lana. Both Sam and Lana are 67 years old. Their combined gross income was $24,250. Let's go get their standard deduction. Their standard deduction is going to be $24,400, right? Well, and then they also get, they're married, right, but they're 67, both of them are 67. They get an extra standard deduction of 13 and 13. So if you add all that up, I don't know what it comes to, but that's going to be 27,000, I think. Their standard deduction, there's their standard deduction, and there's their additional standard. They got a 27,000. No, Sam doesn't have to file, nor does his wife. No. But they should. They'll get a refund. Quinn, age 20, is a full-time college student, is claimed as a dependent by his parents for 2019. Quinn has taxable interest and dividends of $2,500. Let's do his. He's got, now remember, don't do passive income. Quinn has taxable interest and dividends of 25. Quinn, age 20, is a full-time scholar, is claimed as a dependent. He gets the greater of what? He gets the greater of 1,100 and earned income. I don't think he has any earned income, does he? Administration of full-time scholars. Quinn has taxable interest and dividends. That's not earned income. So he'd have earned income plus 350. His earned income is 0, so he's got to take the 1,100. Does he have income greater than 1,100? He does. He's got 2,050. So yes, he has to file. He has to file a tax return, yes. All right, getting very close to the end. We just got a couple more. Okay, this one deals with, I think, something that's very important, and we're almost to the end of the chapter, but this one deals with something, again, your filing status. And the filing status, do you remember if you're single, those are really bad rates. If you're married filing joint, those are good rates. Head of household, let's go over them all real quick. Again, single. You can file as single. Then you can file as married, and you can do it married filing joint. Then you can file as married, single. You can file as head of household. You can file as abandoned spouse. And you can survive abandoned spouse. You can also file as surviving. Surviving spouse. Surviving spouse is also called qualified widower. All of these are different categories, but which rates do you get? Well, again, there is a rate, there are 4 rates. Now you see there's more than one category here. You can file as a single, again, what's the filing status determine which is filing status? Well, again, you can file as a single person, married filing joint, married filing single, head of household, abandoned spouse, or surviving spouse, qualified widower. Let's go over it. If you file as single, guess what? There's something called single rates. If you file married filing joint, well, they have married filing joint rates. If you file as married filing single, they have rates for that, married filing single. If you file as head of household, they have rates for that. That's head of household rates. If you're an abandoned spouse, you'll actually get head of household. You see, again, they don't need another set of rates. They've got enough rates, and they're saying, well, if you can be abandoned spouse, if you are an abandoned spouse, we'll let you use the head of household rates, which are very good rates. If you're a surviving spouse, a qualified widower, you get a very favorable, you get married filing joint rates. So you can see the most desirable is surviving spouse, your husband has died or wife. Also married filing joint is very desirable. Head of household would be the next most desirable. And married single, are, again, any of the singles are the worst. So again, let's see what the criteria is here. I'm not going to write all the criteria out. Let's just see if we can guess them. Okay, Winston lives alone, but he maintains a household in which his parents live. The mother qualifies as Winston's dependent, but the father does not. Well, if you go look that up and read about these, you'll probably guess this sounds like head of household, right? Yeah, this is, again, to be head of household, you need a qualifying child or qualifying relative. And that's what they're going to get here. Again, she lives alone, but needs a household in which his parents live. Winston lives alone, but yeah, head of household. You don't need, yeah, that's right. All you need to have is a qualifying head of household, but he maintains a household in which his parents live. The mother qualifies as, yeah, that would be head of household. H of H, head of household. And that's a good deal. That'll be good, better rates. Winston lives alone, but maintains a household in which his married daughter, Karen, lives. Both Karen and her husband, Winston's son-in-law, qualifies Winston's dependents. Okay, this one's going to be head of household too, I think. Yeah, I don't see anything. You can't get surviving spouse on that. You can't get abandoned spouse. It doesn't say spouse abandoned. Winston's married daughter. Winston lives alone but maintains a household. Head of household, married, single. Yeah, he's going to get head of household for here. To get head of household, let me go over the criteria for that. You got to maintain a house. You have to pay for a house and pay for the mortgage and the heat and the light and utilities. You also have to have a qualifying relative or a qualifying child, one of the two. And in this case, in which his married daughter Karen lives, the Karen's either going to be a qualifying child or a qualifying relative. So he's going to make it. That qualifies as dependents. So he'll get head of household. But you got to have like I said, you got to have a house. You got to have dependents. And what's the other one? They have to live with you. I think that's it. You have to have a house. You have a qualifying child, qualifying relative, and they must live with you. So that's it. Winston maintains a household in which he and his family friend Ward lived. Ward qualifies as Winston's dependent. Now, Ward is a friend. How can he be a dependent? He's a member of the household. He's a member of the house. Remember I told you, he doesn't make it as a qualifying relative. He does not make a relative. No way. But because he and a family friend, he qualifies to maintain a house in which he and the family friend Ward live. If Ward lives with him all year, they'll call him a dependent. They'll call him a qualifying relative. So this is going to be head of household again. Winston maintains a household in which he and family friend Ward live. Ward qualifies as Winston's dependent. Uh-oh. You know what? That's wrong. Because I do remember head of household doesn't give you that exception. No. I'm pretty sure head of house, if you want to get that, in other words, you have to have a qualifying child or you have to have a qualifying relative, but you can't get member of the household. So this won't work because he's a friend. In other words, this rule is to get head of household, you have to have a qualifying child or qualifying relative. You can't have just a friend. They call that a member of the household. That won't work. So he's not going to get that. He's going to have to go with single, which is really a bad deal. He's going to have to go. He will not be able to get, he's not an abandoned spouse. He's not surviving. No death there, I don't think. He's not going to get head of household. He's just going to have to go with single, which is a bad deal. Winston maintains a household in which he and his mother-in-law live. Winston's wife died in 2018. We're in 2019, right? All right, now this one he's going to try and get, remember, a really good deal is if he can get surviving spouse, qualified widower, the same. But to get surviving spouse, he has to have a child. He has to have the same thing. It sounds a lot, surviving spouse is a lot like head of household. You have to have a house. You have to have a qualifying child. It has to be a qualifying child. It can't be a qualifying relative. To be a surviving spouse, you have to have a qualifying child, and they have to live in the house for greater than half the year. So he maintains a household in which he and his mother-in-law live. No, that's not going to make it for, again, surviving. He will not get because it's a mother-in-law. But you know what he can get? He can't get surviving spouse, qualified widow. That's the best deal. But he can go back and get head of household because it's a mother-in-law. That, again, meets the relationship test. So he can get a head of household here. Remember, he meets the relationship with a mother-in-law. Same as part D, except that Winston's wife disappeared. She did not die. I got to think about this. All right? Same as D. So Winston maintains a household in which his mother-in-law lives, except that his wife has disappeared. Okay, he wants to then go for, if he can, he wants to go for surviving spouse. But he can't get surviving spouse because it has to be a child. And his mother-in-law lives with him, so he's out. Can't get surviving spouse. Can he get head of household? Well, I don't think he can get head of household because, again, head of household, oh, abandoned spouse, let's try that. Abandoned spouse, has he been abandoned? Except that his wife disappeared, she did not die. Well, abandoned spouse, again, says to be abandoned spouse, it sounds like it's going to work, but I'll tell you what, to be an abandoned spouse, you have to, again, have a child. So that's not going to work. To be abandoned spouse, you have to have a child, and he's got a mother-in-law, so it's not going to work, he's not going to get that. Can he be head of household? So he's got a household in which his mother-in-law lives, but the problem is he's married still. His wife disappeared, but he's married. So no, he can't be head of household. He's really got a bad situation. He's going to have to go for married and file as single, or just file as single. Yeah, he doesn't meet any of the criteria. His wife disappeared, but the problem is, for him to be an abandoned spouse, he has to have a child. He does not, so he can't get that. Can he be head of household? He can't because he's still married. See, to be head of household, you've got to be divorced. So he can't get the abandoned spouse because he hasn't got the mother-in-law. Yeah, this is a technical one. He can't be head of household because he's married. So he has to go back to being married, filing single, or just file single. So that's a bad deal. Anyway, you see why they're trying to get in. The best groups are head of household, are married, filing joint. But single is the worst. Those are the worst rates. That's very important on how you file. Okay, getting very close to the end. Only one more exercise after this. This is a hard one, though. This goes back to that long-term capital gain stuff. If you remember again, in long-term and short, the first step is we combine all like gains. And after we combine them, we offset them. And we offset all like gains against losses. Offset all like gains against losses. And then 3, we did do one more netting. We offset all like gains against losses. Oh, then we do one more offset. We offset any unlike gains and losses. And then 4, after that, we usually just apply the tax law, which is this. If you have any long-term capital gain, you're taxed at either 0, 15, or 20 are the favorable rates. And let me see. If you have short-term capital gain, it's taxable. It's just fully taxable. F-U-L-L, fully taxable. Let's see if we can follow these rules to any degree. All right, during Inez, had the following transaction involving capital assets. Remember, capital assets are stocks, bonds, real estate, rental property, things like that. Collections, beer can collections, believe it or not, if they're valuable, coin collections. But anyway, gain on the sale of unimproved land held as an investment. Okay, that's going to be long-term capital gain. Loss on the sale of a camper purchased 2 years ago and used for family vacations? No. Even though it's a loss, You can't take a loss on a camper. A camper, it's used for family vacation, it's personal property. So you can't get, now if you have a gain, they'll tax you on it. They'll tax you on that if you have a gain, but if you have a loss, they won't let you deduct it. It's a crummy deal, but Congress passed it. They're the people we elected, and they passed a tax law that I think is crummy. Gain on the sale of ADM, Archer Daniels Midland stock purchased 9 months ago. This is a short-term capital gain. Gain on the sale of a fishing boat and trailer acquired 18 months ago at an auction and used for recreational purposes. So gain on, this is a fishing boat, and it too is used for family, things. But again, it's a gain. Gain on a fishing boat acquired 18 months ago. This is long-term capital gain, and it will be taxable. Do you remember the first step? Combine all like gains, and I should say all like losses. Combine all like gains and losses. And we don't have any, we do have one long-term. Hold it. Gain on the sale of a fishing boat and trailer. Long-term capital gain, short-term. These are all capital gains. Now we combine them. We got long-term capital gain and long-term capital gain. Combine all like gains and losses. Well, let's combine those. If we combine these, we'll have $4,000 of long-term capital gain. And we still have, let's just do this one. Let me erase that and make it a different color. Short-term capital gain. We also have $4,000 of short-term capital gain. Now, can we offset these? Short-term capital gain and long-term capital gain are both gains. You cannot add them. Remember, you combine all like gains and losses. Now we offset, but there's no offsetting to do here. It's gain and gain, so we can't offset. Offset all like gains. That'd be like long-term gains, long-term losses, offset them. Offset any unlike gains. If you're going to do unlike gains, that's going to be short-term capital loss against long-term capital gain. Now that we're done, any long-term capital gain gets these favorable rates. Any short-term gain is fully taxable. So this, the red, the short-term capital gain, that's just fully taxable. The long-term capital gain, that's the one that we get, again, favorable rates. All right. With that in mind, let's see there. It says if Inez's taxable income is $158,000, how much income tax results? If Inez, all right, let's do the easy one first. Let's do again the $4,000 of short-term capital gain is going to be taxed at his full tax rate. And to find his full tax rate, let me pause. Let me go get the tax rates and put them up. All right, I've put up the tax rates. Here's the tax rates, and this guy's single. I think his name was Inez or something like that. So he's going to be using the tax rates right in here. I'm not going to erase the board. I want all this up here. Remember, this was the summary of the problem. We had short-term capital gain, long-term capital gain, each of $4,000. But remember, the short-term capital gain is fully taxable. This guy is making, let me go back and jump back to the other schedule. What did this guy make? He made an A, $158,000. Well, let's go see what his tax rate is. If we go back to his tax rate for 158 is actually, I can't hardly see it here, but it's right there. Oh no, it isn't. It's right here. Isn't it for a single guy, 158? He's in a 32% tax bracket. So we're going to take this. See again, 158 is between these two numbers. He's going to be taxed on that at his full rate. Remember we said $4,000, this is taxed at 32%. So 32%, by the way, am I using the right tax tables? I should be using 2018. This is a 2018 problem. Yeah, I'm using the right schedules. I guess I can just roll those down where we can see him, yeah. Okay, there he is. He's at 158, so he's at 32%. So we'll take this times 32%, and that's going to be what? 3 times 4 is 12, isn't it? Okay, 3 times 4 is 1,200. 2 times 4 is 8. $1,280, I think. 3 times 4 is 12, 2 times 4 is 8. Yeah, he's going to be taxed $1,280 on that. Now, what's he going to be taxed? We need to know, what about that $4,000 of long-term capital gain? And that one, we're going to have to go get the special rate. It's going to be 0, 15, or 20. Let's go check it out. There's a special table for that, and I'll show you that in a second. Here is the special table, and let me rotate it down so we can see all of it. This guy, Inez, he's single. See, this is the tax rates for favorable. You know, again, if you make from 0 to $39,000, you're going to get the 0 rate. If you make from 39 to 434, whoops, am I the right one? Oh, yeah. If you make from 0 to 39, you go all the way over here and you get 0. If you make 39, if you're single and you make 39 to 434, you get the 15% rate. So he gets the 15% rate. So do you see he's right at 158,000, which is there. So he gets 15%. That's going to be 4 times 15 is $600. So the answer to this is $1,880 is what he'll pay. Do you see again, that's what's eventually going to, you know, he's in a 32% tax bracket, but he gets a very favorable rate on a long-term capital gain, and that's what Congress did because they want you to go out and invest in stocks and bonds. It provides capital, money to corporations. And again, the Congress is encouraging you to go out and spend your money on those things. Now, it does ask another thing. Let's go back to the problem and see, it asked us the second part. It said, what if he's low income? Is that 43 we're on? No. There it is again. Let me rotate it just a little bit, get it back where it was. There, that's right where it was on the left. This is the problem again, Inez. It said this was the A. Here's what they asked us to do, and this is the answer to A. And again, now let's try and do B. In B, they say, what if he only made $35,000 of income? Well, if he made $35,000 of income, he'd still have the short-term capital gain, but it would be taxed at whatever he's being taxed at. It's fully taxable. Let's go see what a guy that makes $35,000, what his tax rate would be. So I go over here, and again, I'm going to look at those tax rates. Can't hardly see them anymore. Let's rotate it down. This is a single male, and again, if you make 35, you're in this, 0 to 9, no, 9 to 35, he's in a 12% tax bracket. So he's in a 12% tax bracket. Let's go back to the problem, and we'll say, all right, he has to pay full 12%, that's what he's, 4 times 12, is that $480? I think so. Yeah, 4 times 10%, 10% be $480. Now, what's he pay on that long-term capital gain? The $4,000 of long-term capital gain gets a favorable rate. I'm not going to go look at the table again because I can tell you, if we go look at the table, this guy's in low enough income that he's going to get the 0 rate. You know, again, if you go back and look at those favorable rates, he's at a low enough income that he's going to pay 0 on that. He's going to get the 0% rate. So he'll pay 0. So again, his tax will be $480. That will be the answer to B. So A, a higher income man or woman is going to pay more income taxes. B, a lower income man is going to get that favorable, or Inez, I think it could be a woman, I don't know. But anyway, he gets 0 favorable rate. But do you see that in either case, the long-term capital gain gets a much favorable tax rate? And that's, again, I believe the last problem. We're going to do one more summary, wrap it up problem, then we're done. This is the last problem, but it's a wonderful problem. It truly is a tax return. I mean, this is the climax of the chapter. They're going to give us the story, and this is a very common tax problem. This isn't something that's super complex. This is just your average guy, but it's still hard. Let's pretend this guy is you. Logan Taylor, that's the guy's name. And again, this is the wrap up of the chapter, but Logan Taylor is a widower. His wife Sarah died on June 6, 2016. Maybe he's going to qualify for surviving spouse. We don't know. He lives at 4680 Dogwood Lane, Springfield, Missouri. He's employed as a paralegal by a local law firm. During 2018, we're doing the taxes for 2018, it looks like. He had the following receipts. Let's start out just by going over and seeing if we can do gross income. And you know what? I think for this problem, I think I'm going to have to move my videotape and, well, let's read the problem a little bit more. Let's read the problem a little bit more, and then I'm going to solve it over there. But salary. He makes a salary of $8,000. That's taxable. Money market account at Omni Bank. That's taxable. Saving account at Boonstein Bank. That's taxable interest. City of Springfield general purpose bonds. City of Springfield is a municipality. It's another governmental entity. So that's not taxable. Put across, that's excluded. Remember, government, the federal government doesn't tax state and local governments. Inheritance from Daniel, $60,000. Remember, when you inherit, when you get a gift, that's not taxable, excluded. Life insurance proceeds, that's not taxable, we can exclude that. Life insurance, Congress doesn't tax death. They do, but you're not going to learn about that yet. The account or amount from the sale of a St. Louis lot. I don't know what to do with that, to tell you the truth. You might say, well, isn't that income? Well, we don't know what it cost him. Let's say it cost him $1. Well, then he's got a $79,999 profit. But, let's say it cost him more than that. He could have a loss. Proceeds from estate sale. Let me check. I might have a battery that's going low. No, it's okay for now. Proceeds from an estate sale. Once again, I don't know quite what to do with that. I don't know what his basis is. In other words, did he sell something that he paid, let's say he paid $10,000 for it, then it's a loss. But maybe it'll tell us down here. Federal income tax refund from last year. Well, we don't have to worry about that. That's not income. Remember, he paid the money in and got it back. So again, that doesn't put him, he doesn't have income. When you pay something and get it back, you're in a position of parity, of equilibrium. You haven't changed. So there's no taxable income there. Logan inherited securities worth $60,000 from his uncle. That must be these. Who died in 2018. Well, Logan also was designated beneficiary of an insurance policy with a life maturity of $200. Well, we took care of that. That's $200. The lot in St. Louis was purchased on May 2013 for $85,000. So we bought this lot for $85,000. And we sold it for $80,000. That's going to give us long-term capital loss of $5,000. So we bought it at $85,000, sold it at $80,000. We got a long-term capital loss because he bought it back in 2013. Because the neighborhood was deteriorated, that's why they sold the lot. Logan decided to cut his losses and sold the lot this year for $80,000. That's what we got, $80,000. The estate sale consisted largely, that's these things. He got $9,000 from this estate sale. Belonged to Sarah and Daniel, and again, it was fishing stuff, hunting equipment. Logan estimates that the property originally cost them twice the $9,000. So they paid $18,000 for this stuff. And they lost, if they paid $18,000 and got $9,000, that means they lost $9,000. But they don't get that. In other words, this is a loss of $9,000. But you don't get to deduct it. Let's just do it this way. They really did get the money, but they paid $18,000. They sold it for $9,000, so that's a loss of $9,000. But it's a loss, but you see the difference? This was on a lot. That's property that they invested for. That's profit property. That's like bonds and stocks. But this is personal property. Personal property, you're not going to get to take this loss. So just draw a line through all of it. You're not going to get to take that loss, but you're not going to have to pay any taxes on it. Back in action. Battery went dead. Loads expenditures conclude the following. Well, I'm going to have to rotate this up to see his expenditures. We're not going to be able to see them all. But let's we know we've got enough for gross income here. Let's go ahead and let me pan over and let's do gross income. Remember how the tax formula works? We've got enough information here, I think, to do gross income. All right, let's do it. All right, we'll do GI, gross income. And the gross income is, he's got a salary of $80,000. He's got interest income of $300, $1,100. Savings account, we don't have to do those municipals. Inheritance from Daniel, no. Life insurance, no. Amount from the sale of that lot, no, that's a loss. Proceeds from real estate, no, none of it. So this will give us gross income right here. And that's going to be $81,400, isn't it? $81,400. There is your gross income. Now, do you remember we now have deductions for adjusted gross income? Now, again, they're not that common, but deductions for. And we do have one. He lost $5,000. That's a long-term capital loss. He can deduct $3,000 of that. So he can deduct $3,000 of that. That's the limit. Congress just set that limit. So you can deduct $3,000 of that. And then that will give you, after you take out your deductions for, adjusted gross income. And that will give us what? $78,400? Okay. 78,400. Now we want to go get what? We want to deduct either the standard deduction or itemized deductions. Well, what would be the standard deduction? We've got to scroll down and read the rest of the problem because we need to know, is Logan going to be, head of household? What's he going to be here? So let's see if we can scroll down. And I'm going to erase the board. I'm going to stop it just for a second. Okay, I scrolled down, and this is the remainder of this problem. I want to make sure that's going. It sounded like it was going. Yeah, it is. 13 seconds. Here's his expenditures. Now remember, we've got to find out what standard deduction he gets, but let's look at his itemized. He's got medical expenses, $10,500 for dental. Now these are unreimbursed medical expenses. See, it says down here that $10,500 was a dental charge for Helen's implants, and those were not reimbursed. So these are itemized. Taxes, he can itemize these. State of Missouri income tax, 42. Property taxes on his residence, 45. Interest on his home mortgage, he can take this, 56. Contribution to church, he can take that. In fact, I believe all of these are itemizable. So let's just go ahead and let's do a little, let's do a list over here of his itemized. He gets $10,500. He gets, oh no, that was $11,500, sorry. $11,500. He gets property taxes in the state of Missouri, he gets 42. He gets 45 for property or taxes on his mortgage, isn't it? Is it interest on the mortgage? No, property taxes. This state of Missouri income tax includes withholdings. Okay, so there's his income taxes, property taxes, and interest. There's the interest on the mortgage, $5,600. I'm not going to take that subtotal. I mean, I don't want that subtotal. I'm just going to do everything individually. This is subtotal, right? 42, yeah. And then contribution to church, he can take that too. Contribute any cash contribution, he can take there's a limit on those, but, oh, there is one thing though. There's a limit. You can only get, again, the excess of itemized deductions when it comes to medical. There's a rule that you can only get above 7.5% of your AGI. In other words, you can't take all of this. You have to subtract from that, take that and subtract 7.5% of AGI, which AGI is 78,400. And that's the amount you can take. Let's put a multiplication sign in there. Will this work on the math? In other words, you are not allowed to take your full medical. You can only take the amount above 7.5% of your AGI. So let's get that. We got 78,400 times 0.075. That is 5,880. 7.5% of AGI. In other words, from 0 to 58.8, you cannot deduct that, but you can take the amount above it. So now I'm going to take 11,500 minus this. I'm going to actually, let's even do it this way. So it's minus this. Let's take the 11,500 and put it up here. This is a minus sign, and we know that's going to equal 58. So now we'll subtract that. That's a subtraction. So minus 11,500, that's $5,620. The amount that he is above, and in other words, this is called a floor. In other words, what I mean is he has to get up to 7.5% of his AGI. Once he gets up to 58.8, he can deduct what's above that. You see? Take it from there, that was the amount above 7.5%. That's 5620, so we can do 5620. And now we have his itemized deductions. If we take 5620 plus 4200 plus 4500 plus 5600 plus 4800, we get 13,480. I don't think I did that right. I know I didn't do that right, because that can't add up. That's 5, 10, 15, 20. That's way more than that. It's got to be a mistake. Let me try that again. Okay, 5620 plus 4200 plus 4500 plus 5600 plus 4800. And that's 24,720. So there's his itemized deductions. Now we got to go get his standard deduction and compare it to that to see which one he's going to get. Now remember, it's good. We got to find out, is he a qualifying widower, head of household? What is he? Let me scroll down and see if it tells us what his filing status will be. All right, that was just about the dental charges. This is about his pledges that he made to church, but those are deductible. Logan's household, he supports the following. Logan Taylor, 48, that's him. That's the guy that's running the whole thing. Helen Taylor, age 70, I think that's the grandmother, because I think his wife died. I'm pretty sure his wife died, so that's his mother. Ashley Taylor, that's a daughter, and that's, well, I guess he has two daughters, Mia and Ashley. So Helen receives a modest Social Security benefit. Asher's son is a full-time student. What we need to know here is he, I don't know, when did his wife die? Let me scroll back and see when his wife died. Oops, I went too far, I think. She died in 2016. She died in 2016, and it's 2018. He's going to try and get surviving spouse. He can get it in the year of her death, so he can get it in 2016 and get it for 2 more years, 2017 and 2018. So will he qualify? Remember, to get surviving spouse, he needs a qualifying child. He needs a child to live with him for the year. Let's go down and see if he's got that. Once again, let's see if any of these dependents are a qualifying child. So that's the man who's doing this, or whatever his name, Logan. That's his mother living with him. Asher, age 23, and me at 22. We need a qualifying child. Remember, there's got to be a relationship test. Both of these will meet that's the son and daughter, so they meet that test. Then there's the residency test. I think they said they live with him. Supports the following. Logan's household, of whom he supports the following. Helen receives. So anyway, they all live with him. So they're in there, the residency test. Now we need, again, the age test and the support test. I think he already said he supports it. So just the age we need to check out. And that's 19 and 24. Well, Asher Taylor is 23. That's too old. And Mia Taylor's 22. They're both, but do they go to school? Helen receives a modest, Asher, oh, here it is. Asher, a son, is a full-time student in dental school, but he makes $4,500. That doesn't matter if he makes $4,500. That's a test for qualifying relative. We're testing qualified child, and again, Asher is 23, which is less than 24, and he's a full-time student. He makes it. So this guy gets, he's going to get the surviving spouse qualifying widower. That means, again, he's going to get married filing joint rates, which is going to get the $24,400. So we can go over and compare that and say, what is greater? His standard deduction is going to be, standard deduction is $24,400. The 24 or the 24,720, which is greater? The itemized is. So let's just erase that. We're not going to use the standard. We're going to use this, the itemized, and we're going to deduct it. We're going to take the AGI and deduct 24,720. All right, let's do that. And that's $78,400 minus the itemized deductions, which are 24,720 minus, that's 53,680. So that's going to be, after I do that, 53,680. Now, that's again, let's go ahead and label this. This is itemized still. He's got $53,680, and this isn't taxable income yet. We've still got one more thing. He does get remember when I told you, again, it's very important, we've said all along, if you can get qualifying children and qualifying relatives, you get a tax credit. And the tax credit for qualifying children is $2,000 a child, and it's $500 for a relative. So this is the child tax credit, C-H-I-L-D. This is for, again, a qualifying relative. They both have to be dependents. But the rules are different in that a qualifying child to get this credit has to be 17 or less. Would you see again, none of these people are less than 17. None of them. But they are all relatives. They do qualify for the $500. Now, he can't get one for himself, but he can get a $500 for his mother. He can get $500 for his daughter and $500 for Mia. Now, he'd get $2,000 if they were less. They have to be less than 17. Is that right? Yeah, less than 17. Not greater, but less than 17, and he can get $2,000. But he's not going to get that. He's going to get $500. So we would say less the tax credits, and the tax credits are $1,500 each. And then we're going to take that and subtract it. It's $53,680 minus $1,500. I should have just done that math. Gives us taxable income of $552,180. So there is the taxable income. Now, I don't know if they actually ask us to compute the tax. Let me go back and check the beginning of the problem. But that's the hardest part, getting down to taxable income. Okay, I'm back. This is all correct, but I should back up just a little bit. He does get the tax credits. I'm going to erase those. Those are tax credits he's going to get off his tax bill. And that was a correct computation. We've got to do just a little step before we give him that. In other words, this is his itemized, this is his taxable income. That's it. We want to go now get the tax on that. To get the tax on that, let's go out and let's get those tax rates. And we need, remember again what we need right here. Let's erase this over here. We need married filing separately? No. Married filing joint. That's what we need. Married filing joint. And again, to get his tax, he's got 53,680. 53 married filing joint. 53,680 is right here. 53,680. How much is he going to owe? He's going to owe $1,905 plus 12% of anything amount above 1905. So let's go ahead and get that. I'm just wondering if I can do that. Let's do it right here. I think I've got room. Again, let's take, he's going to have $1,905 plus anything over $19,050 plus 19, he's by the way, he is over at 53,680. 53,680 minus 19,050, anything above that. Take that times, remember he's going to pay 12%, times 12%, and we'll have his tax. And let's go ahead and do that real quick. Again, let's take the 53,680 minus 19,050 and take that times 12%. That's $3,463. It's $3,463. Adding that to, again, the $1,905 plus 1,905 is equal to, he's got tax that he owes of $5,368. That's the tax he owes. So let's put that over here. That's taxable income. His tax due is $5,300, did I say, and $68. $5,368. Hang on a second. Okay, I'm back. Here's our computation again. Remember again, anything over 1950, which we had $53,680. And again, I subtracted this. I got a little different answer. I don't know why my calculator than before, but anyway, it's all the same numbers. 53 minus 19, take it times 12%, you get 4156. Add the 1905, and you got $6,061 in taxes. That's the tax due, $6,061. But remember, you've got withholding. You remember, and you've got also a tax credit. So that's the tax that you owe. But we already said he has 3 tax credits. And those are, again, remember, $500 each times 3. So that's $1,500. This is actually a negative number. This is tax he owes, but he gets credit. So he gets $1,500, and he also had some withholding. He had some withholding for the year. Let's go see what he had in withholding, and then we'll know if he has to pay tax or not. And again, let me switch back to see if he had some withholding. Yeah, there it is. No, that's not it. Well, here it is. Logan's income tax for 2018. Federal income tax of 45. Yeah, here it is. Federal income tax of 4,500 was held from his wages. So there it is. Part 1, do the tax computation. Again, they're asking us down here to do, but they did say there was withholding of $4,500. So let's add that. Remember, that's taxes withheld. Well, the tax credit, I believe 45,556. Now we know that, again, he's got $6,000 in taxes, in credits, so he actually owes, the final thing is he owes in taxes $61. Right, 61, that's the tax due, he's got $6,000 in credits. I think that is, yeah, that is going to be the amount that he owes. And that thing, this is wrapped up, we are done. Do you see how a tax return works? All the gross income, you get the greater the standard or the itemized. In this case, he had more itemized. There's his taxable income. We had to go get the tax due with this formula right here. We got the tax due, $6,061. Then we go back and take out the credits. Then we go back and take out withholding, and you get $61 that you owe. That's exactly how your tax returns work too. That is a great problem for an overview of the whole chapter, and that's how you'll have to do your taxes someday. Only I suspect your taxes will be more complex because you probably will have more investments, and as you get older anyway.